Hey everyone, Longacres Finance here, and today I'll be taking a closer look at the Dividend Aristocrats. And more specifically, I want to show you which ones are undervalued right now based on dividend yield theory. Dividend yield theory is a simple valuation technique where you compare the current dividend yield to the trailing dividend yield. If the current dividend yield is higher than the trailing dividend yield, the stock is potentially undervalued, and vice versa. The keyword here is potentially, because no valuation method is perfect, and dividend yield theory, like other valuation methods, isn't always accurate. However, do you know what's better than a dividend aristocrat? Buying a dividend aristocrat that is trading at a fair or better price. Because price is what you pay, but value is what you get. Identifying undervalued or even fairly valued stocks means that you are able to purchase shares of a stock with a better than average dividend yield. And it can also increase your future total return if the stock reverses back to its historical yield. Dividend yield theory was popularized by investment quality trends. They have utilized this method to outperform the broad market since the 90s. I'll leave a link to their website in the description below for anyone curious to learn more about them and their track record using this strategy. If you're new to the channel, make sure to subscribe for more weekly videos on dividend investing. Alright, let's jump right into the undervalued dividend aristocrats. There are 15 potentially undervalued dividend aristocrats right now. Let's take a look at each one. The first undervalued aristocrat is At&t. Based on dividend yield theory and the 5-year trailing historical dividend yield, the stock appears to be 1.23% undervalued right now. The stock did offer better dividend yields in the recent past, but still trades for a slightly more attractive yield than its trailing average. The current dividend yield is about 4.5%, which makes it one of the better dividend yields amongst all the aristocrats. The next undervalued aristocrat is Becton Dickinson & Company, and they are 1.53% undervalued. The stock has hugged its average dividend yield over the last 5 years, occasionally crossing north of the line, offering investors a better buying opportunity. The current dividend yield is rather low, but historically the stock has never offered a high dividend yield. Up next is IBM, that is 2.38% undervalued right now. The stock was more undervalued over the past few months, but more recently the dividend yield has trended downward. IBM, like At&t, is one of the highest yielding dividend aristocrats. Up next is Franklin Resources, that is 2.74% undervalued. Similar to IBM, Franklin Resources offered a much more attractive dividend yield in the recent past, but more recently that dividend has trended downward. The current dividend yield of 3.35% is a pretty generous one for a dividend aristocrat. Up next is Cardinal Health, that is 3.85% undervalued right now. Cardinal has hovered above its trailing dividend yield since early 2018, and only recently started to trend downwards. In March of 2021, the yield dipped below the long-term average, but has pulled back thus far in May, bringing the current yield back above the trailing yield. Up next is Federal Realty Investment Trust, that is 5.77% undervalued. Federal Realty became undervalued back in March of 2020 and peaked in October of last year, offering a yield above 6%. Since November of 2020, the share price has been recovering, and today's yield is closing in on the long-term trailing yield. Up next is Kimberly-Clark, that is 6.34% undervalued right now. The stock has flirted with its trailing dividend yield during the past 5 years. In 2021, thus far the dividend yield has remained above the trailing yield. The share price has remained flat this year, but the company did increase its dividend by 6.5%, giving the dividend yield the boost it needed to climb above the trailing dividend yield. Up next is Consolidated Edison, that is 7.97% undervalued right now. Comet's dividend yield jumped up in February of 2020 and has remained elevated since then. More recently, the dividend yield climbed again, peaking at about 4.7% in February of this year. Since then, the dividend yield has trended downward, but still remains above its long-term trailing average. Up next is Hormel, that is 8.26% undervalued right now. Hormel has oscillated back and forth along its trailing dividend yield during the past 5 years. Since August of 2020, the dividend yield has trended upwards, mainly due to the share price declining, but also helped by the dividend increase of 5.15% this year. Up next is Atmos Energy, that is 12.11% undervalued right now. Their dividend yield has crossed above the trailing dividend yield in August of 2020 and continued to climb until February of this year. The dividend yield peaked around 3% and has since pulled back some, but remains above 2.5% right now. Up next is General Dynamics, that is 12.75% undervalued right now. General Dynamics' dividend yield was a real bargain in March of 2020 when it crossed 3%. The dividend yield has trended downward recently, but still has a ways to go before it dips below its trailing average. Up next is Exxon, that is 12.89% undervalued right now. Exxon's dividend yield was a true bargain in September and October of 2020 when it reached double-digit levels. Exxon has not raised its dividend since 2019, but remains a dividend aristocrat because on an annual basis, the dividend has grown from 2019 to 2020. However, if the company fails to increase its dividend before the end of this year, they will lose their dividend aristocrat status. Up next is Chevron, that is 13.89% undervalued right now. Chevron's dividend yield looks similar to that of Exxon. However, the yield in 2020 did not climb quite as high as Exxon's did. Unlike Exxon, Chevron raised its dividend in 2020 and also this year. Both these oil giants offer some of the highest dividend yields of all the dividend aristocrats. Up next is Walgreens, that is 14.01% undervalued right now. Walgreens' dividend yield was the juiciest back in October of 2020, reaching a high of 5.5%. Today's dividend yield is about 2% lower, but still remains above the sub 3% trailing average dividend yield. And the last, and potentially most undervalued dividend aristocrat right now, is At&t, that is 16.46% undervalued right now. At&t has always offered a very generous dividend yield, and today's yield is pretty close to the 5-year high. However, the recent news of the Time Warner spin-off and merger with Discovery, and the almost certain dividend cut that will follow, may mean that At&t will soon not be a dividend aristocrat anymore. Time will tell how all of that will shake out, but it's certain the 7% dividend yield is not very safe at the moment. Look, usually the market is pretty efficient at pricing stocks, meaning that when a stock is potentially undervalued, there is usually a reason why. Sometimes those reasons are more evident, like in the case of At&t, but sometimes it can be less obvious reasons, like cyclical industry fluctuations. You should always research a company before you purchase shares of its stock, to make sure you are comfortable owning the company and to avoid a potential value trap. Obviously, reviewing each of the 65 dividend aristocrats individually can be a very time-consuming process. The valuation method laid out in this video is a quick and dirty tool that can help you narrow down which companies you should focus on first. Of course, there are other valuation methods or ways to identify stocks for further review. I track 2 dividend watch lists each month that can be very useful tools to identify new stocks for your research. I'll leave a link to the most recent watch list in the description below in case you are interested. Starting next month, I will begin tracking the undervalued dividend aristocrats each month to see how well they perform versus the rest of the dividend aristocrats. In theory, a strategy of investing in undervalued dividend aristocrats should underperform in the short term since the stocks are out of favor. But in the long term, it should outperform the dividend aristocrat index through the additional alpha generated by stocks returning to fair valuation. I'm curious to see if that will be the case. If you'd like to see as well, come back next month for the first update. Before I wrap up here, let's quickly run through all the other dividend aristocrats that are not potentially undervalued right now. I'll do this in alphabetical order. Up first is Abbott Labs, that is 16.5% overvalued right now. Archer Daniel Midlands is 36.96% overvalued right now. This would have been a nice stock to buy in March of 2020. Automatic Data Processing is 10.4% overvalued right now. Aflac is 0.58% overvalued right now. It just barely missed the cut. Amcor is 6.21% overvalued right now. A.O. Smith is 1.19% overvalued right now, also just barely missing the cut. Air Products and Chemicals is 16.2% overvalued right now. Brown-Forman is 31.97% overvalued. Caterpillar is 56.46% overvalued, and also would have been an excellent purchase in March of 2020. Chubb is 12.38% overvalued. Cincinnati Financial is 26.69% overvalued. Colgate-Palmolive is 8.48% overvalued. Clorox is 1.3% overvalued, barely missing the cut. Cintas is 8.84% overvalued. Dover Corporation is 64.86% overvalued, as the dividend yield has more than halved during the past 5 years. Ecolab is 17.85% overvalued. Emerson Electric is 37.39% overvalued. Essex Property Trust is 1.7% overvalued, which is pretty close to fair valuation. Expeditors International of Washington is 50.43% overvalued. This stock has been featured on the monthly high growth dividend watch list and has performed quite well since it was added. Genuine Parts Company is 20.92% overvalued. Grainger is 39.47% overvalued. Illinois Toolworks is 17.04% overvalued. Johnson & Johnson is 12.1% overvalued. Coca-Cola is 5.81% overvalued. Leggett & Platt is 18.32% overvalued. Linde is 40.38% overvalued. Lowe's is 43.34% overvalued. McDonald's is 12.85% overvalued. Medtronic is 15.71% overvalued. McCormick & Company is 9.26% overvalued. 3M is 0.33% overvalued, just barely missing the cut. NextEra Energy is 15.75% overvalued. Nucor is 77.09% overvalued after the recent spike in price of steel. Realty Income is 1.38% overvalued. People's United Financial is 15.55% overvalued. Pepsi is 4.67% overvalued. Procter & Gamble is 13.5% overvalued. Pentair is 39.29% overvalued. PPG Industries is 35.84% overvalued. Roper Technologies is 10.22% overvalued. Sherwin-Williams is 18.53% overvalued. S&P Global is 20.11% overvalued. Stanley Black & Decker is 34.31% overvalued. Cisco is 9.37% overvalued. Target is 138.15% overvalued. Wow, that is a huge discrepancy. 4 years ago, you could have picked up shares of Target with a 4% dividend yield. Today, it is closer to 1%. What a run for the company. T. Rowe Price is 17.99% overvalued. VF Corporation is 10.05% overvalued. Walmart is 37.64% overvalued. West Pharmaceuticals is 125.01% overvalued. Another huge overvaluation, except this company did not even offer a generous dividend yield 5 years ago. But what they lack in the yield, they sure made up for with capital appreciation. And that would be it. That's all the Dividend Aristocrats. Thank you for watching and see you next time.